Hey, Tyler Ross, Real Estate owner and broker in Warrenton, Virginia. I'm here with a couple guests today, and we are going to nerd out on lending and credit. So, the idea here is to have Dave and Chad talk. Dave.
So I'm Dave Couk, mortgage loan originator with Integrity Home Mortgage. Um, One of the things that we get involved in on the mortgage side is credit repair when necessary. And so we brought in our guest today, Chad Kusner with Credit Repair Resources. Chad is an industry expert, probably one of the most knowledgeable people that I've met with regards to credit. And we're going to have Chad address a couple of things. And just to give you a quick background on how this came about, more and more frequently, when I am pre-qualifying people, one of the things that lenders have to use, we have to use a tri-merge credit report for purposes of the credit part of this. So the analogy that I use for people is that the loan process, think of it as a three-legged stool. The seat is the mortgage loan, and the three legs supporting that are, of course, the collateral, the house that is being lent against, your income or your ability to repay that debt, and last but not least, the credit piece of that, your credit scores and debt. So one of the things that I'm seeing pop up is when I do a tri-merge credit report, I always want to share that with my borrower right up front, and I say, hey, Mr. and Miss Borrower, here's your credit scores, here's a copy of the report. Take a look at it and make sure that it is accurately reflecting what you know about your credit. We want to know if there's something in there that shouldn't be, etc. And what I'm finding more and more is happening is that with a lot of these credit services, I'll send a copy of the credit report and tell the folks what their scores are, and they say, well, you know, Wells Fargo says I'm an 830 and your report says I'm an 805. Or I had one where somebody said Credit Karma says I'm a 690 and you tell me I don't even have any credit scores. How could that be? So I know it's fairly complicated, and therefore we wanted to bring Chad in today. When I spoke to Chad about this a month ago, Chad started explaining the different models and what was happening on the FICO level, and it was confusing to me. So being in the business, I figured if it's confusing for me, it's got to be overwhelmingly confusing for the consumer. And so that's why we're here today. So Chad, if you wouldn't mind explaining why are there these discrepancies? How do these discrepancies exist? And what's the difference? And just give us your dummy it down for us and explain this to us.
Excellent. Well, hey, I appreciate it. By the way, Dave, Tyler, thanks for having me on today. I definitely appreciate you giving me some time to come and talk to you about credit. Of course, as you say, geek out, that's my job. I mean, I call myself a credit geek. And one of the most confusing things is the variance in credit scores. And candidly, it's the reason I'm in this business. Back in 2005, I wanted to buy a house where I live now, 14 years later, and I pulled my credit. My scores were really low, and actually found a guy to help me out. He was an attorney, and he told me to look at my credit again. And instead of looking at a hard pull, I went to, at the time, remember freecreditreport.com, with the jingles and all that. I went and pulled my credit. I went from a 577 to a 760. And I was like, oh my goodness, this guy, it can walk on water. I'm going to get the best possible loan product I could, because I was a loan officer. So I went back to my desk and I did another hard pull, and I was a 676. And I saw a 100-point disparity. And I was like, that's not right. And I was really angry and frustrated, like most consumers are still to this day. Spent almost 2 hours waiting for a live body at freecreditreport.com for them to tell me, sorry, Mr. Kusner, we use a different credit scoring model than you. And that really sparked my, I guess, interest and passion to really understand this, because it was so deceiving for me, a guy that looks at credit reports every day. So that's kind of the whole impetus for why I'm sitting here 12 years later and not still originating mortgages. I'm helping people with their credit. So it's this whole subject matter. So it's near and dear to me. So anyways, when you look at credit scores, first of all, there's over 200 commercially available models that are out there, meaning banks have their choice of all different types of credit scoring models to choose from. So, and when it breaks down by industry, you have to understand that a mortgage lender is looking at different criteria and looking at different risk behavior than a car lender. A car lender is more worried about your repossessions and making your payments on time than they're worried about you having a home. The same thing when you look for credit cards. Credit cards are looking for your default on unsecured debt, and whether you pay your revolving debts on time, they could care less about your car and your house. So the models are all going to be developed based on the risk that they're trying to identify, right? So like right now, my credit card score yesterday was 818. And I'm not bragging, I'm just saying I've been checking it. And I need to get my wife a car and went to my local bank. My auto score that they pulled was 828. I go to my Credit Karma and I'm a 778. So I am seeing all these different scores based on where I'm at. And when you can break it down and people can just understand that it's all based on what you're trying to buy is where that's going to be. And anything that you see on the internet is going to be what's called an educational credit score. They're not a credit score. So it doesn't matter at the end of the day what any online credit score tells you your scores are until you go and ask, I want to buy a car, I want a student loan, I want a home, and they actually hit submit for that credit report. Those are the only scores that matter. So, and it's hard to get someone to understand that and get their arms around it. So when people have a scenario where they're trying to buy something bigger in their life, the best way for them to get a true picture of their credit scores is not Credit Karma. First of all, let me talk about that for a second. They do an amazing job at what I call creating credit for Sesame Street, because they've distilled it down to that anybody, a 12-year-old, could log in and follow the prompts and understand their credit scores. But when you really want to understand the details, and it's something that is important for one of the biggest purchases in your life, it may not give you all the insights you're looking for. So I always recommend it to hop over to myfico.com. That's myfico.com, myfico.com, because most lenders today are going to use that company's credit scoring models, regardless of what you're buying. When you create an account and pay the $60, it's not a cheap date, for that credit report, you get your mortgage credit score, which, by the way, that's the only place on the internet, if anybody listening to this now and in the future, the only place you can look at your mortgage credit score is through myfico.com. Everything else doesn't matter. And even that might have a slight variance as to what the lender pulls, but it's going to be the closest. But MyFICO gives you your mortgage score. It gives you two different auto scores. It gives you two different credit card scores and a generic score. But what's nice is it breaks down all the ratios. So anybody that's out there that's really trying to understand what's going on with their credit and be savvy financially, that's the best place to go to, because at the end of the day, nothing matters until that number comes back, and to be proactive is the best. So does that help at all? I hope I didn't just muddy the water even more.
No. And in fact, as we talked earlier, and Tyler knows this, whenever I'm asked what is my number one piece of advice for someone looking to buy a house, I always say, get with me or your lender, if you already have one, 3 to 6 months before you're ready to have him make an offer on a house, because if something comes up that you're unaware of, we have time to address it and fix it. Case in point, I pulled credit for a guy last year who he'd never been late paying a bill in his life. And he expected his scores to be somewhere in the high 700s. And in fact, when I pulled his score, it was like a 705, and showed a collection with Comcast for $125. And he went absolutely bananas, because he said, how could I have a collection with Comcast? I'm on automatic bill pay. My bill gets paid automatically with them every month and has for 5 years. Where the heck did this come from? So he called Comcast, and they admitted it was a mistake. But he'd already taken a hit on his credit score. It had already dropped 40, 50 points, whatever it was. And he went crazy over that, which I understand, because Comcast wouldn't fix it. They said, well, you're going to need to do this and that. And they admitted that they made a mistake, but they wouldn't reach out to the bureaus and just say, look, we made a mistake here, fix this. And it took us, 2 months before it got resolved. And so I can't imagine.
That's a perfect example. Yeah, that's a perfect example of nothing happens fast in credit. You know, especially if you're talking a scenario that was not at all his fault, and you're here trying to get Comcast to concede and remove, rightly so, a collection from the credit report. Still took you 2 months. Imagine somebody that has a bump or a bruise for a couple months at a time, where a few payments maybe did go late, right? Or maybe a collection that they may have owed or may not have owed, a couple of them show up. When those small life events happen, or a big life event happens, even if, let's say the collection, oh crap, I forgot about that thing from the doctor, I do owe him $240. As soon as you pay it, especially in the mortgage world, your score doesn't automatically go back up again. A lot of times, even when you pay a collection, if it shows a zero balance, it's still there and has an impact on the score. So other things have to be done over the subsequent couple of months to help boost the scores back to where they need to go. So you're exactly right. Anybody that's looking to buy anything big, really 3 to 6 months you have to be monitoring. And this is my PSA for everybody that listens to this. If you're not monitoring your credit regularly, you have to. And I'm not saying this like I'm a doctor, you have to eat an apple a day. What I'm saying is that since 2005, 11.5 billion records have been stolen. That means our stuff, all three of us, I'll bet $100 with each of you right now, that our information has been stolen at least 3 times over the last decade. Whether you like it or not, whether you know it or not. What happens is these breaches happen, and these guys sit on these massive data pools, because they're not just going to come and hit you the day they steal your stuff. They could come back a year later, 2 years later. They're smart, and they ding you for $1 or $2 at a time, because if they've got 11 billion records, let's say collectively, and they're getting $1 a day from the people that they've stolen from, that's $11 billion. That's a pretty good revenue model. So you have to monitor your credit from a personal standpoint. That's just to help being healthy, staying in, making sure that you're monitoring your health and level, so that if you are going to buy something big, you're already in there. But if you're not that type of person, absolutely 6 months is huge, because nothing happens fast. And even the people that say they got divorced 3 years ago and everything was finalized and the bankruptcy's discharged, that stuff's still sitting there. And to turn a credit from a 580 credit score to a 680 credit score is not always like a 2 month or 3 month process. Sorry to go on a diatribe there.
No. I can speak directly to what you were saying about that $100 bet that I will not take, because Amex is currently tracking down $2,500 for me that accumulated $50 a time, over the last 18 months.
Yeah. Oh, so little tiny ticks they're hitting for you, right? Yeah. And that's the tax. And they can work to even try and mask it as someplace that you'd buy from. Mm-hmm. Because your banks, you'll notice, listen, if somebody goes to Target in Connecticut, and I use that example because it literally happened to me, the bank's going to notify you almost immediately. They know you live in Ohio, it's a transaction in Connecticut, something's afoul. But when they see $1.37 and a BP at 3 miles from here, they're not going to question that. So as data security gets better, hackers continue to work to try and stay on top of it. But so you're right there, Tyler. Wow, I'm sorry about that, bud.
Oh no, well that American Express I love very much. So I'm very happy with the effort that they're putting in for me. But I want to kind of we've gotten into the weeds really quickly, and we haven't really even gotten an opportunity to properly have you introduced. Could you tell us who you are, the name of your company, and what you do?
Yes, I appreciate that. So I'm Chad Kusner. I own a company called Credit Repair Resources, and we're based out of Cleveland, Ohio. We work nationally. My organization started based on my partner being a consumer protection litigator, now over 25 years, helping consumers against collectors and creditors most of his career. I was an originator for about 10 years, and we were introduced through my wife, who's a paralegal, and over the first couple of years, 2005, 2006, we beta tested. 2007, I got licensed as a credit service organization, and here we are going into 2020, and we've got thousands of partners across the country. We've helped thousands of people navigate the way to being mortgage ready, as we call it. And I think one of the key things that makes us different from what you might see out there on the internet or from people referring you or hearing any stigma is we are advocates first. So we make sure that any referral that is sent to us or anybody that calls us, we find out what you need first. Because a lot of times people have a low credit score, they don't need credit repair. And so to make, listen, everything's about relationships. And if I took with someone, one of Dave's referrals, and took their money when they didn't need my services in 6 months, saw no benefit, I'd probably never see another referral from Dave. So we've known that from the beginning. So really putting the consumer first, making sure that we're offering services that meet their needs, and then being effective at what we do behind it is what made us good at what we do. So when you come to us, we look at your credit, see what's happening. If we don't think we can help you, we're going to recommend counseling or potentially bankruptcy or another service. If we think we can help you, you get an advocate. And literally my case managers, which I tout, I kind of like the guy that's sitting here in front of you, but the people that are in the trenches with, taking the grenades are my case managers who have been with me 10 years. They are former underwriters and credit managers from places like Bank of America and AmeriCredit Auto. So they're super smart, and we just love what we do. So that's our job, is to take anybody that's looking to buy or refi and get them in that position as quickly as possible and keep everybody informed. It's that whole kind of, it takes a village mentality that we have.
So Dave being a longtime loan officer, me being a longtime real estate agent, and you working in credit, it's really easy for us to get lost in the weeds on real estate specific stuff. But like, what's your typical demographic for a customer? Is it people buying a car, people buying a house? Like, who do you typically work for?
So people that have been through what we call life events or economic events, right? Bankruptcy, job loss, medical, anything that might prevent, if I said divorce, whatever it is, anything that you have a calm, then you have a storm, whether it's 3 months or 3 years, and now they're on the other side and need to do something financially. They're getting married again. They want to buy another house. They need to get security clearance for this new job they have. Whatever it is, the perfect scenario for someone that would benefit from our services, or someone that has had that thing happen to them that's unfortunate and are on the other side and need their credit to catch up with them. So that's the actual clientele. But the reason that we find our wheelhouse in the mortgage world is, one, it's the one that has the most restrictions when it comes to trying to get approved. And it's typically people that have had bad credit a lot of times don't look to try and fix things until it's time to do something big, right? It's kind of like your tires. I say, when people have bald tires in the car, they know they're not going to buy tires because it got me to work today. One more day it'll get me to work. But when that tire, you see that bubble in the sidewall, then when you need to make the application for the mortgage is when you start sourcing for the new tires. I'd use a lot of analogies, but that's why people are motivated. They are committed to the process of making a lasting change in the mortgage when they're looking for a mortgage. So those are our best clients. But when it comes to buying a car, and not that we don't have clients that come to us for that, quite frankly, I don't know if you guys have looked to buy a car, but they're like, I talk to these guys, they're like, yeah, we're getting 490s bought. It doesn't matter if they have 3 repos, as long as they have a $3,000 check to put down. In the car business, all due respect to that, it's just a different animal altogether. So that's why we try to stay in the mortgage world.
Well, I want to highlight something that you pointed out, because Dave and I are here in, Warrenton, Fauquier, the outer reaches of the DC area, and that how important credit is to security clearance. I'm sure there are a lot of folks in this particular area that would benefit the process of getting their clearance. So let me ask a question that kind of feeds all of those branches. What percentage of people that come to you are coming to you as a result of a surprise? Like, a lot of people know they have bad credit for a long time, and then a lot of people only find out because Dave did a soft pull and they're shocked.
I would say that there's a higher percentage of people that come to us that are like, it's finally, you go to the dentist for the 3rd time and he's digging into that cavity. Those are our clients. But we do have a good number. I would say it's probably a 70-30 split of people like, oh my goodness, I had no idea this happened. And in a lot of cases when that happens, I don't even recommend them signing up for our services. I'm here to help you guys get deals funded. So if I can help them identify the proper course outside of our services for one account that, recently hit their report, I'm going to give them that information, because the faster I can get that resolved for them, the faster I'm going to get more referrals. So, that's the one-off stuff we get a good bit of. A lot of times they don't even need our help.
I want to ask you for the very first piece of practical advice that you've touched on a couple times, that being monitoring your credit. Do you have a recommendation to my clients, Dave's clients, your clients, on a good way to go about monitoring your credit?
So if you're in the process of trying to restore your credit for a mortgage, if you let's say your scores are lower, I recommend two. I recommend having Credit Karma. First thing I want you to do is go to annualcreditreport.com and print all three reports. Get all three credit reports. Annualcreditreport.com is awesome, but when you go there, you can get all three reports directly from the bureaus once a year, or if you've been turned down for credit, those reports are direct data. But the challenge when you get those is it's not monitoring. You're getting that most recent, most detailed snapshot of each bureau independently. Pardon me, if you have a thick file is what we call it. Like, I've had credit since I was in my, early 20s, maybe even sooner. I have a pretty thick credit report. So when I look at all three reports independently, I've got like 40-page reports. Now I got 120 pages of data in different formats. So that's why, mortgage lenders use what we call tri-merge credit reports because they combine all three into one. So start at annual because then you can really do a detailed scrub. On a weekly basis, I like Credit Karma because it lets you refresh your scores every 7 days. So you can see what changes have happened. So it gives you that more real time and it's free. However, you don't get Experian, right? Experian doesn't participate in any of these free services. That's why when you go to Credit Karma, you get TransUnion and Equifax. Experian you need to pay for. So there's like Identity IQ is very good. Identity Guard, or you can go directly to any of the three bureaus and use any of their three bureau monitoring services as long as you look to see that you have a refresh for a new report every 30 days. So as long as they don't charge you for that subscription on top of it for that updated report, that's what I would recommend if you're motivated to make the purchase, because you really do need to see that Experian report. So yeah, I mean, it's kind of like a 3-layer. If you're really vigilant at a minimum level, if you don't have a Credit Karma account, they're free and there's no obligation to use anything that they have. You're doing yourself a disservice because I go in every 7 days to refresh and see if there's anything that's hit, and nobody wants to get hit by a surprise whether you need something or not.
So here's a question regarding oh, no, go ahead. I didn't mean to cut you off.
No, go ahead. I'm fine. I'm good.
So when I do a tri-merge credit report, we use Credit Plus. And one of the things that I like about Credit Plus is when I get the report for my borrower, it has each of the bureau's scores, but underneath of it, it has potential score increase. So just from doing this now for going on 10 years, I pretty much know when I see a big number for potential score increase, like 50 points, without even scrolling down and looking at the rest of the credit report, I have a pretty strong feeling that there's some pretty high credit card balances in there. And therein lies the opportunity for them to jack their scores up by simply paying some credit cards down. I don't even have to look, and I know that's what I'm going to see. My understanding, and correct me if I'm wrong, is that the reason that some people will think their scores are higher is because the score that they're getting from Credit Karma or wherever they're getting it from might be more closely correlated to that potential score rather than an actual live score. Is that correct? Because one example, I pulled credit for a couple years ago, and Credit Karma said that she had a 690 credit score. She had 3 zeros on her tri-merge credit report. When I did a little bit of digging into it, it was because Credit Karma was giving her credit off of a old credit card that she had been joint with her ex-husband. And it was just kind of bizarre. And I frankly didn't understand it. Neither did she. How can Credit Karma say I have a 690 and your tri-merge says I have 3 zeros?
So Credit Karma, next time you log in, if you have that account, underneath your score for TransUnion or Equifax, it's going to say you're viewing Vantage Score 3.0. Okay, and that Vantage Score is a scoring model that was developed by the 3 reporting agencies. Right, FICO is separate altogether from them. So they said, let's create competition for FICO and made this company. So that's where you're getting that score from. But the differences are going to be what it identifies as scoreable accounts. So typically when you're seeing a score on Credit Karma but no scores through a tri-merge on a mortgage report, it's because they're actually and I would have to look at the reports. Typically, it's because there's not enough seasoning on open accounts. So when you open a credit card and you go to Credit Karma, and the first month that it reports, you get credit for that. Hey, Chad got a credit card. Sports, right? You get a participation prize. But when you go to FICO Classic specifically requires 6 months seasoning of new accounts before it will provide a credit score based on that criteria. So what that means is they need to see what's my behavior. Give me 6 months to show me you can pay this credit card on time. Now, if you mention an authorized user account, if it's reporting I need to see the reports, and this kind of creates a little mystery for me because what the good thing about an authorized user account, here's a great tip, is when mom, dad, sister, brother, cousin, somebody adds you as an authorized user on their credit card, that authorized user gets instant credit for all dynamics of that account. So you get credit for how long it's been open, you get credit for the pay history, the available limit, and the current balance. So as long as all those are in the wheelhouse of being positive, you are going to see some improvement. Now, if there's only an authorized user account and that's it in the lender report, that it may have pulled up a 0 score because there was nothing individually for the consumer. So that particular poll may have said, this is only an authorized user account. We're not going to give them credit because we need to some of their own individual activity. And that could have been why it happened. Because that's what you mentioned, right? The only thing she had was an authorized user from her ex-husband.
Yeah.
Was that account still open? Do you remember?
I don't remember. It was two years ago.
Sure. But I think that the important thing to remember is the key difference is a couple of myths that I'll dispel right here. Pay my collections and my scores are going to go up. Okay. Under the auto world and student loan world and anything that's using a newer FICO model, that's the truth. When you pay off collections or charge-offs, they're what's called bypassed by the credit scoring model. So your scores, boom, are going to jump up. In the mortgage world, the credit score that's being used currently when you pay off charge-offs or collections, they're saying, wait a minute, that's not a green light that Chad's a better buyer. That's saying Chad's paying off bad debt. That means he probably wants to buy something. Okay, and when you're trying to buy the biggest thing in your life, they're going to let your scores drop at first so that you can prove the likelihood that you're going to default is low. They're not just going to go ahead and say, here's your sticker, thanks for paying your bad debt. And that's where I think consumers get frustrated because they're like, Chad, I paid my debts. I want my score back, right? I paid my debt to the impound lot. I want my car back. Give me the keys. It's not the same. I flip the script on them and say, listen, if you're a lender, and we can draw the authorized user in this, and somebody says, you know what, Chad wants to borrow a bunch of money. He just paid off a bunch of bad debt, and he has just an authorized user account. Let's say throw that in there, right? Or just an authorized user account. The bank's going to say inherently, this isn't giving me a good roadmap of Chad's who he is now. Let's see what he does over the next 6 months. And in reality, and this is opinion 100%, if there weren't so many advocacy groups and the regulators trying to push for more credit to people that don't have access to it, it would be this way across all models. But because there has been so much pressure to give people that don't have access to credit more credit, they have now geared these models to bypass paid debt, negative debt. Let me ask you a question. If I borrowed $500 from you, Tyler, and said I'll be back in 2 weeks, and then 6 months later I come back with $220 and go, Tyler, that's all I have, man. I owe like 5 other people money, but I know I owe you, man. Will you take it? What are you going to do?
Of course I'm going to take it. But I'm
okay,
also
and what if and you knew about this, Dave. You knew about this, Dave, and I came to you for a mortgage loan. And it was your money to write the check 2 weeks later. What are you going to say to me?
Probably not thinking it's a safe bet for me.
So that's where we have to understand. As much as we feel as consumers, well, why are they taking advantage of me with a low credit score? We have to understand that as much as bankster rhymes with gangster, right? That's my joke. But they also have a right to make sure that their investments are going to be protected. If they're going to lend us money, I want to have a good probability that you're going to pay me back. So it's kind of both sides. You have to look at it from both sides of the tail. I hope I didn't go too far there.
No, well, kind of a shameless plug for what I do is I view myself as more of a mortgage counselor. I know that the State Corporation Commission, because of my licensing, I'm with the NMLS, license number 399299, equal housing lender, blah, 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 for compliance. But I have to call myself a mortgage loan originator. But the reality is that when I'm pre-qualifying borrowers, oftentimes I'm doing a lot of counseling. Case in point, I have a loan now where a young fella has several collections in his credit, but they're all small. And I know that I can get him to the finish line without him paying off the collections. And he says, well, I'll pay him off. And I'm like, no, 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 I don't want you to pay him off because your score is just high enough that we can get you an FHA loan. I don't want your scores to drop. And I know from experience, as Chad alluded to, if he goes and pays off those 3 small collections, it could drop his scores enough that he's no longer going to be eligible, or if he is, for a really bad rate. So that's something that I'm making him aware of, and I've counseled him through that. So we're going to get him to the finish line. So therein is my tip of get with a mortgage lender 3 to 6 months ahead of time so that you stay between the lines and don't derail yourself and run off in a ditch doing something that you thought in your mind would have been beneficial, but in fact was not.
It's tremendous testimony to the idea that your intuition doesn't always apply to whatever it is you're trying to accomplish. I think we'd probably all agree intuitively you would pay off your debt, your credit would be better, but just from the stories that we've heard, that's obviously not the case. So we got to encourage people to go talk to professionals before they start making financial decisions that they think might work out. They should confirm. And Chad, I'd like to do a couple more of those FAQs you were about to get on, if I may. The first
yeah, I wanted to dovetail that because the I'll pay it off reminds me of people a lot of times over the years have said to me, Chad, don't you feel like you're being deceptive to creditors and debt collectors? I mean, what you're doing. Or people call and say, Chad, what if I owe all these debts? I mean, what are you going to do for me? Well, why would I use your services if I owe everything? And my response is unequivocally the same thing every time is I'm not here to play judge and jury. Okay. It's not my job to prove whether or not you owe them. It's not my job to absolve you from the debts. It's not my job to prove that the debt collector does or does not owe me. Has the information. It's our job to put the proof of debt, as consumers have that right, on the person that's collecting. So what we're doing, in fact, is going through a verification or validation process on everything on the credit report that's holding the scores down. So when people say, I'm just going to pay off all my collections, and I'm like, well, how do you know what you really, really owe? I mean, if these people don't have proof of debt and are unable to collect on it legally or report it to your credit report, wouldn't you want to know that? And if we do get them verified and they come up shooting with what I call wet ink, then we're going to coach you on your best practices to resolve these accounts. But before then, let's go radio silent. Let me do my job that we've been doing, my partner's done for a quarter century, put the proof of debt on them, and then try and clear the plate a little bit so that we can then identify what needs to be dealt with. And that's one of the things that consumers need to get their arms around with what we're doing. And my analogy is, I do a ton of them, is you get pulled over having a few pops at the bar last night and you get a DUI, you don't sleep all night, and your attorney calls you at 11 o'clock the next morning and says, hey, listen, I don't know if you drink either or not, Dave, but hey, Dave, listen, I looked at this thing. I can get this thing reduced to no points, $500 fine in court costs. You'll have 10 hours community service and a 6-month suspension, or we can cop to it. And it's going to cost you about $6,000. You're going to lose your license for 2 years, 6 points. Oh, and goodbye to your insurance. Which one are you going to take?
It's a no-brainer. Hey,
right? Give me the misdemeanor. Take it. Yeah. Right? And that's my point, is that all we're doing is applying the consumer protections that are inherently there for them. So that it's to their best benefit. Because for you to go and read the Fair Credit Reporting Act or the Fair Debt Collection Practices Act and understand how to apply that if you had a bad economic crisis, it's not what you do. Now, listen, some people will go and get their transmission from online and they're going to drop their car and they're going to change it all out. I had a buddy of mine that changed a drive shaft in his Honda over the weekend. I'm like, dude, you're crazy. I would never consider it. So it's all based on where you are and what your personality is about our services. But when you're looking to do credit repair, it's not so much of whether or not they can help or should I pay these things if I owe them. It's what's the actual process that they're going to do. What are these guys going to do other than just pop shots and dispute letters for you? So we can go into my process if you're interested, but that's a different situation. But FAQs, I wanted to just throw that on there. But what do you got for me, Tyler?
Yeah, so the first one that pops up is when we were talking about credit monitoring and talking about doing these polls regularly. Can you speak to whether or not pulling credit at a particular pace actually impacts your credit?
Hard pulls, soft pulls, absolutely. So this is pretty simple if you break it down. First of all, unless you're going to a car dealership and they load you up into 10 different lenders and shotgun you out, getting a hard credit pull is typically not that much to worry about. Okay. First of all, impact is 5 to 12 points. They only stay on your credit report for 24 months, and they only count in our credit scores for 12. So it's, at the end of the day, people get very worried about inquiries. But to understand how this works in the mortgage world, in the auto world, in the student loan world, the bureaus and the scoring models understand we have the right to shop. So there's something that's called the shopping window, right? Or it's technically called the deduplication window if you want to be a geek like me. But the shopping window allows us to shop for a mortgage and not have to worry about shopping for more than one, with more than one lender potentially, or having a lender update my credit report, impact the score. So the window works like this. In the mortgage world, it's 30 days. So you pull your credit score in the first, there's 30 days in the month. You got that whole month to go ahead and get your credit pulled. At any point, if Dave needs to update your credit report and do a new hard pull within that 30-day period, the window reopens another 30 days, right? So it's what they call a rolling shopping window. So I get my credit score pulled on the 1st, my closing date is the 30th. If they pull it again on the 12th, it's the 12th of the following month now. Make sense?
Mm-hmm. Sure.
Yeah, except that realistically, when I pull somebody's credit, I'm pulling it in the pre-qualification because Tyler wants to know, hey, I got Susie Smith wants to go buy a house. Can you pre-qualify and let's figure out how much house she can buy and whether you can get her a loan. So I'm pulling Susie's credit and then I pre-qualify her and I tell Tyler she can buy a $450,000 house and they start looking. I don't have to pull another credit report as long as we get to the closing table within 90 days of that first pull. So our company is going to do a credit refresh, usually a day or two before closing, because I just had one yesterday. I got a loan closing Friday, had a credit refresh yesterday, and they're going to do a soft pull just to see if any new debt has occurred since the time of application. But to your purpose, we're doing that hard pull in the pre-qual, and I might not ever pull their credit again if they close within 90 days of me pulling.
Chad, could you tell?
And that's great because your protocol is there. Go ahead. I'm just
could you tell us the difference between a soft pull and a hard pull?
Oh, definitely. So anytime that you go to the internet to go look at your credit score, any single one of them, it doesn't matter who it is, you're applying for a consumer education credit score, a consumer report. So you're able to look at those all day, every day, 24 hours a day, and it's never going to be considered a hard pull. Those are the most basic of soft inquiries. Other types of soft inquiries are what your existing lender, credit card companies really do it on a more frequent basis. They do what is called account maintenance. So they're going to look at your credit card and look at your credit rather to see if you're defaulting or late on any of your other credit cards. Are you maxing out other credit cards so that they can see your overall behavior to make sure they either want to raise your limit, lower your limit, keep it the same. So those are considered soft. The hard inquiries are anytime you say, I want a car, I want a loan, I want a credit card, I want a student loan, I want a TV. Anytime you're making the application for an offer for any type of credit, it's going to be considered a hard inquiry for them to move forward for that approval process. The soft inquiry has become much more prevalent so that lenders can get a bird's eye view. But as soon as you move forward and say, let's do this, they have to do a hard pull so they have that, they can memorialize that score and lock that pricing level in.
Very cool.
Does that make sense?
Yep.
Absolutely. Another FAQ probably said, when somebody has used a credit card for a period of time and then determined that they just don't want to use that card anymore, should they keep that line of credit open or should they close that account?
So, they use this joke way too often, but my partner said he went to 3 years of law school to learn this answer. It depends, right? Well, the reality is this, I made this mistake when I bought my house in '05 because I was going through credit repair and he didn't give me any advice. So I went and closed 2 credit cards. And when I called him back, he's like, "What'd you do?" He was, because you don't want to. Your credit cards are one of the key things that we're scored on is our average age of accounts, meaning how I look at our oldest account and our newest account, add them all together, how long they've been open. Our average age of accounts has a moderate level of impact on our credit scores. So if you're going to go and say, well, I don't want these credit cards anymore, I'm going to close them all out, and you start closing out credit cards that are 10, 15 years old, you're now reducing your average age of accounts and can negatively impact your credit scores potentially. So anytime someone's trying to close out and say, Chad, I just have like 15. I've been to every store. I took every incentive for the last 3 years. I just don't like having all these out there. What you'll want to do is close the newest accounts first. So anything like I have a Banana Republic card, I shut it down every year because I wait another 12 months and then I open up to get the extra incentives for the purchase so I get a new set of clothes for the year, whatever. So I'll close out that because it's never more than a year or 2 old. But I have an American Express card literally from 1993 that I refuse to close and pay the $55 every year, even though I don't use that card, so that it keeps my age of accounts. So again, to recap that, closing accounts isn't necessarily the worst thing, but you want to make sure you're keeping your oldest accounts open, whatever's going to make your average age of accounts the highest and give you the most overall utilization. So while we're talking about this, closing credit cards, we're scored based on the open date. We're scored based on whether or not it's still open. We're scored on the payment history. We're scored on the available limit versus what we currently owe. Follow me here, individually on each card and in aggregate, okay? Meaning adding up all of our available credit cards and then what we owe as a total utilization is a huge part of our score. So if you have a $30,000 credit card you got approved for last year and close it out, you've just lost that headroom. So you want to look at age of accounts and limit. And if you're confused still, you call me and I'll hook you up.
So
does that make sense though? So those are really kind of any criteria where it is, because it's not just a yes or no answer.
Right.
So to show my own geekiness, and I've shared this with some of my clients, I've got 6 credit cards. And I keep I just keep a little ledger sheet. And on my ledger sheet, I have the name of the credit card, what the credit limit is, and any balance that I have on it. If my balance gets to 30% of my credit limit, I do not use that card again until I pay it off. And I might pay it off that month, but if for whatever reason I don't, I just put that card in the drawer and pull out another card. And that way I never have a card that has more than a 30% of my credit limit balance on it, because I know from doing credit simulation that the lower that balance as a percentage of your total credit limit, the more juice I'm getting on my credit scores. And correct me if I'm wrong, but from doing the simulators enough, it seems to me that the sweet spot seems to be somewhere around 19% of total credit limit. Once you get to 19%, I've done simulations where I pay it to 0 and I don't really get anything else for paying it to 0 versus having the balance at somewhere around, south of 20%. Is that accurate?
So, the models are all going to have different tolerance levels of what they're going to look at as far as utilization ratios. But from everything we understand in the FICO world, 0 to 7%, really 1 to 7 is going to be, that's optimal. And if you go to myfico.com, not only is it an awesome report to buy, but they have a score simulation tool you can use on your own there. And they give you a 50 point band every time you get a score. But what we've learned is the middle is the delta. And so by understanding that, when you look on there, 1 to 7 is really optimum. The reason we want some balance is so that you're showing activity and responsibly using those accounts on a monthly basis, and it brings those into the algorithms. Let's call it 8 to 30% is going to be that next level. So you, like you said, that sweet spot of 19 is absolutely going to be there. 30 to 50 is going to be a more of a neutral impact. And then once you start going over half of what you owe versus what's available, the banks are going to go, why is Chad borrowing half of this at 18%, 26%, whatever his credit card rates are? Something must be, impacting him financially. So that's where you look at it. 1 to 7, 8 to 30, and then 31 to 50, and then anything over that is there. But to your point, when you're using these cards, a good tip is if you're, let's say I bought a washer and dryer on a $5,000 credit card, right? And now I owe $2,800, but I need to get my score, keep it optimized. Knowing this, and this is kind of a little bit convoluted, but you have your due date on your credit card statement, right? Your statement date is the cutoff date. The statement is when that balance, whatever you owe on their statement date, is what's sent to the 3 bureaus. So that's the balance they think that you owe currently. So let's say I buy these washer dryer for $3,000, and now I am way over 50%. What I'm going to do is make my payment 3 days before my statement date, so my new balance is $300 again. Make sense? Mm-hmm. If I'm going to pay it off, I'm paying it off before the statement date, so that $300 balance is what's going to be sent to the bureaus. So it doesn't even show on my scoring model that I spent that money. It's keeping my risk level low. So if you're trying to buy a house, but you need to buy some appliance and have the cash but want the points, make sure you get that payment made before your statement date. And the way to calculate is, by law, it's 21 days before the due date. Does that make sense?
21
Does that help?
days.
I think I need you to repeat the thing about 21.
So my credit card, so my city card is due on December the 5th. So you're saying,
let's call it the 21st.
Okay.
I'm saying your statement date is the 1st.
Right.
So on the 1st, they're required by law now to close out your account, purge what you owe to the bureaus, send you your statement. So now you have basically 3 weeks to make your payment and schedule it. So they used to only send our statements like 5 days before the due date because they wanted us to be late. Yeah. The credit card bill of rights from 2009 now requires all credit card companies to have a statement date 21 days before the due date. Gotcha. So that's why we know that is specific. It's not something that's like different with Chase versus Citibank. It's 21 days. And that's here's my geekiness. The CARD Act is called the Credit Card Accountability, Responsibility, and Disclosures Act. And right? Say that 10 times fast. But my point is when you're trying to buy a house and you're looking at all these ways how to improve my score, that's a key one, is making sure that you know what's being reported to the bureaus. Because listen, let's say they have a $4,000 balance and your simulator is telling you, hey, pay this down to $300 and you'll get that 30 points. What does that cost you to do a rapid update? $35 per bureau, right? It's $105 just to have the balance updated. They can do it for free if they're just a little bit proactive.
Gotcha.
So considering somebody coming to you is likely in credit card trouble as they need their credit repaired, I'll use the foundation or premise that they come to you because they've overspent. Do you notice a particular way that people are overspending, whether it's credit card, consumer debt, cars, student loan, houses? What's kind of the most common mistake people are making in their consumption?
I mean, the biggest, it is, it's all in the news. It's student loans is really the number one. If I could say one thing that we see more defaulted loans on, more people owing more than they originally borrowed, it's going to be student loans, because here's the reality is you can defer your student loans right while you're in school interest free. The day that you graduate, you can defer them for another year if you haven't found the right job, but starting day one, you're accruing interest above and beyond what you owe, right? So, a $5,000 student loan 6 months after graduation can now be a $5,700 loan. Mm-hmm. So, and then you can't make those payments after that 12 months of deferment. Now you're in default. So student loans is definitely the key one. The second one for me is definitely credit cards. And when you're maxed out on your credit cards, credit repair is not going to help. It just doesn't. So if anybody's saying, don't listen to them, we have an in or we have ways, we refer anybody that's maxed out on credit cards to the nfcc.org, which is the National Foundation for Credit Counseling, which is, again, the nfcc.org. What's nice about that is they're not an actual counseling company, but they're government endorsed to be able to basically endorse local counseling companies that are ethical. So when you go to the NFCC, they will go ahead and have you put in your zip code. They'll redirect you to a local credit counseling service so that you can get help that's legitimate and ethical. I stay away from any of the stuff on TV when credit cards are maxed out. A lot of these companies actually are either already the credit card companies or they have a conglomerate that works together with them. So they're there just like anything else, or a collection company on TV. But the credit counseling companies, they're not there to lower your monthly payment. The reason we refer people to them is because they already have agreements that are legitimately reducing the interest rate or payment structure set up on that account. So your payment doesn't drop $500 a month. You just go from paying everything off in 40 years to 3. They'll take and work out better interest rates. And as long as you make your payments on time with the counseling company, they'll disperse to the credit card companies. So when it comes to, that's just kind of the tip. When people are maxed out and they're wondering if they should call me, their first stop should be the NFCC.
So where, just for edification purposes, so where I'm using Chad is I pull a credit report and I see that they've got high credit card balances. I'm not sending them to Chad.
Mhm.
I'm going to tell you, Tyler, we can get your scores up 40 points if you'll just pay your credit card balances down.
And you identify that through
And I know I'm not a credit repair specialist, but a lot of this is common sense. And that you're either going to pay them down or you're not.
Mhm.
And when I am totally out of my pay grade is if I see a bunch of collections or even a judgment and you're like, at a 550 credit score and you're like, dude, I really want to buy a house. I'm going to send you to Chad because he's going to know the quickest way to resolve that and get you to where you need to be. I'm not messing with that.
Mm-hmm.
Plug for his company. Chad called me one day. I called him back, went into the voicemail of the main line at his company. I did not leave a message. Somebody called me 40 minutes later and just said, we saw your number calling in. What can we help you with? I'm like, wow, Chad's got these people trained. This is customer service, baby.
Well, listen, this is the mortgage and real estate world. And if you're a consumer, you may not know, but we are on call at all 3 levels, 24/7, right? I mean, if, we need something, information needs to be given as quickly as possible. And a lot of times that thought that's in your head is there now and might not be in an hour, or a realtor, or there's, a domino effect, right? There's 3 deals pending on this thing. I need an answer right now, whether or not it's going to happen. We're sensitive to it. My coordinators that you talk to, they're former loan officers. I've really specifically hired everybody that's got experience that pertains to this business so that we all have that sense of urgency. So I appreciate that feedback. I'm glad that happened.
Yep.
Good stuff.
So I guess I want to ask a couple questions about the benefit of having good credit. Even if you're not going to buy something, your attempt isn't necessarily to qualify for something, but does it affect the interest rates you might get on buying a car or anything else?
So it is. And it's interesting to me that most people don't really care about it until they want a house. Mm-hmm. And that's where why we have really focused on where we do. But it's our credit, and this is on our website, and I've said this my whole time in this business, it's our resume to the financial world, basically. When you want something, it doesn't matter. Anything that you pay for that you're not paying cash for is being affected by your credit, whether it's your property insurance or auto insurance, anything it doesn't matter. The cell phone and the rates that you get on your cell phone, what you're paying for your cable, what you're paying for your clothes, what you're paying for your car, anything that you're not paying cash for, our credit's affected by it. So not paying attention and optimizing it is really at the detriment of our own financial well-being and freedom. Not having debt is awesome. So I'm not telling anybody you need to go out and have debt in order to have good credit. But if you're looking at it going, well, I pay cash for everything, I don't need it. You really need to look at it, because just small changes and just using the smallest amount of credit can mean, worlds for what your credit score is. And you don't have any idea that when you apply for auto or home insurance, did you know that poor credit in Ohio can cost you double what having a DUI is on your auto insurance?
Had no
Not a joke. So it's like average of $900 a year for an individual with a DUI. And these are real studies done on averages. If you have poor credit, it could cost you as much as $1,700 a year for auto insurance.
Good gracious.
Wow.
So the reality is it doesn't matter. If you're not paying cash, you need to have good credit. Even that job. What about applying for a job? Here's a good myth buster. People say that your employers can look at your credit scores. They can't. They can look at our credit reports, because they don't need, they're not assessing our risk level based on what our risk scores are. That's more of for pricing tiers and where you fit in that loan that they're going to give you. But from an employment perspective, they're allowed to look at all the information on our credit otherwise, so that they can see, does Chad pay his bills on time? If Chad's in financial trouble, do we really want to give him the authority to have access to capital, right, or any income like that? So it can cost you for your job as well, if you didn't know that.
Wow. Well, I've got kind of a foundational question to ask you, and it's going to be about the credit card business model. Like, I've heard people refer to me as like a deadbeat for American Express, because I use 20% of my limit every month, and then I pay it down to zero every month. So they get absolutely nothing out of me, except they give me points that I get free stuff to go buy. So could you tell us what the credit card business model is?
The credit card business model is, and I say this in the most sincere term, it's the most modern form of slavery there is. Their whole goal is for us to miss a payment, go late, max out our card so that they can increase our terms, our interest rate, and make more money off us, charge us penalties. They make money when we don't do things right. You're exactly right. I applied for a Chase Inc. card, right? Chase Inc. will give you 80,000 miles if you spend an X amount of dollars in the first 3 months. I'm just about there, and I pay it off to zero every day. I go in and buy something, I'm just moving payments over. But that's where, it's rigged against us from the very beginning, the whole credit card scenario. Nothing makes them happier than when we're late and we go over our limit. Now they can charge us an over the limit fee, an extra month of interest, and raise our interest rates. And that's where they make their money. And that's what they're always banking on. So, if you're going to have credit cards, man, is it important to understand how fast it can drag you under. Case and point is, if you look, and now what's also required under that Card Act is the true cost of funds window. So when you get your credit card statement, if you have a balance in that little red box in the middle, it says, if you make the minimum payment, you'll be paying this $3,000 for 37 years. And that's not a joke. Some of these minimum payments will go out 30, 40 years. Make an additional $100 every month, you'll be done in 3. And the disparity is really, really just like that. So knowing that, they love when you make minimum payments. They love when you go late. They love when you go over the available limit. As long as the rest of your credit looks good, they'll keep charging you and keep taking your money. So the credit card industry is something that, can work to your benefit if you're responsible, and it can absolutely crush you if you're not careful.
So think twice before we get that 15% off at Banana Republic or wherever it is.
The only reason you do that is if the money's in your checking account and you're like, heck yeah, I'll save another $35. But if you're like, well, I'm going to get this stuff now, and because I'm saving the money, I'll go ahead and pay it off in a couple months. I pray for everybody to just change that behavior, because that's how we get in trouble. It really is. I see it time and time again.
That's awesome.
Well, I think in the now 9.5 years I've been in this business, I've seen one 840 credit score, and local business owner. I'm not going to give the name, but had an 840 mid score, and or 840 was her high score. I can't remember which of the bureaus it was, but She had credit cards that she'd had for 30 years, long history, paid everything off every month, and was 2 months ahead on her mortgage payment. Like, we're doing a refinance and she'd already paid, we're doing a refinance in April and she'd already made her June payment, and I've never seen.
Well, that's being responsible.
That's the only 840 I've ever seen.
And that's where. So I have the quest for the 850 score, right? That's the top of the FICO chain.
I've never seen one.
I've been, like I said, my auto score of yesterday was 828, but that's on a 900 scale, right? So auto scores is sometimes certain models are going to have a higher score band. But to your point there, Dave, is that she has a thick file. She has demonstrated over a series of decades that she can manage her credit responsibly, and that's where you get into that 800 range. So people are trying to get from 570 to 640, right? I mean, that's it's not as easy as you would think. I mean, we have to work to get it, and that's where I firmly believe that you don't get a participation prize for opening a credit card. You gotta show that you can use it responsibly, and that lady clearly had demonstrated that. And I know one person, and it's my friend and colleague and business partner, John Oldtimer, I do an event with. If you look up that guy's name, he's the smartest guy that I know in credit. He worked at FICO for 6 years, at Equifax for 7, and he's the only guy I never knew that hit 850. And it was like 1 month he got it there. But here's the deal. So everybody listening to this, let me go ahead and, all that is look at that extra ripple in my muscle, because anything over 760 in any lender that I've seen in the United States, if your scores are 760, that's about as high as it ever will need to be. That's what you're looking for
you're getting our top tier pricing. So our rate, you're getting our top tier pricing at 760. 800
Correct.
Isn't going to get you anything else. It's just bragging.
Nope.
Bragging rights.
I was just going to say bragging rights.
That's about it.
Cool.
Yeah.
Well, I'll do my best to kind of summarize our conversation. And in the meantime, if you can think of anything at the end of my brief little monologue to chip in, please do. The first is that we should all be monitoring our credit scores. The second is that scores are different depending on what it is that you are buying. Third, that if your credit's not where it should be or where you want it to be, you should seek out counsel or an expert to help you get to where you'd like to be. And it's having good credit is not just when you're going to buy something. For the example in Ohio, it impacts your insurance, your car insurance. And student loans is one of the biggest problems that us as a country are facing right now. And then also that the fix is in. The credit card companies can be helpful if you use it responsibly, but the incentives are to get you in trouble.
100%. Well said. Well said. There are a couple things. So if you're seeing commercials for Experian Boost, have you seen those commercials? The new first way to boost your score. Experian has come up with a program called Experian Boost that if you allow them access to your checking accounts and any of your deposit accounts that you pay bills out of, they'll scan that for any recurring payments that are consistent. And then if they find them, they'll allow you to add that payment history to your credit report to boost your Experian score. Okay. So here's the thing. I'm going to go off for about a minute here. So the credit reporting agencies have more data regarding us personally than you would ever want them to have. See, they only provide the consumer credit report to lenders with the criteria that's allowed by the Fair Credit Reporting Act, our ability to repay debt, our identifying information, name, addresses, employment, stuff like that. So, the phone numbers, that stuff is on our credit report. But the bureaus, they hold all kinds of information. They're mining our social media. They're mining anything that they can get data on us to understand our behaviors, because there is something called a personal investigative report. That let's say you are trying to get security clearance for a private security company. They can order our investigative report and get everything on us, our personal habits, religious beliefs, anything that we put out there in the web is open game, and they're collecting it. So that's one. And I just lost my complete train of thought with that. I hate when that happens. I was going somewhere good with that. But understanding that that all of our data is out there, and you know what? That's going to happen to a guy that's 48 sometimes that's thinking about this stuff all day.
Wait till you're my age.
Oh, Experian Boost. Wait a minute, going right back to the tool. Experian Boost gives them one more bit of access to our financial information. So now, not only do they have all our social media and everything else, now you're letting them into your checking and savings account. So to me, that's another scary proposition. But when you do that, it may potentially increase your scores. But the reason I mention this, it has nothing to do with mortgage credit scores. So Experian Boost is not going to help with your mortgage credit score at all. So if you're saying, well, I'm going to see if that helps, Dave, if somebody calls you and asks you that, or Tyler, can this help with my mortgage credit score? Just let them know, no, not at this time. It's not retrofitted to that model. The other thing that's out there right now is this Ultra FICO score. Have you heard of Ultra FICO?
No.
So Ultra FICO is a supplemental credit score. It's not even one of the three bureaus. It's a supplemental Experian credit score, okay, that now they look at your savings accounts and your investment accounts, and they look to see how you use as far as all your other activity. How much are you saving on a monthly basis? What are you putting in retirement? How much do you have? And they're now incorporating that into a supplemental credit score called your Ultra FICO score. Again, you know, I don't know any lenders that are currently using that, and then you're giving one more bit of access to these companies for them to just know every single thing personal about us. And to me, again, it becomes more of a, you know, where are we in the matrix here?
So Big Brother
So those are a
really
couple
is
tools out
watching.
All day, every day.
Wow.
That's awesome. Well, do you have anything else for Chad?
No, just I appreciate your work and all that you're doing to help Integrity Home Mortgage and our clients. And again, I still say what I've always said: get with a lender 3 to 6 months before you're ready to have Tyler make an offer, because if I can't help fix it, Chad probably can, but you got to give us some time to fix what needs to be fixed.
And to your point, one last thing is, I will tell you this: if somebody calls me and says, Chad, I have all this work to do, and even if they're the perfect candidate and they're like, but listen, I'm under contract, I got to be done in 60 days, I'm absolutely going to tell them I can't promise it, and I won't guarantee any of that. And if they're adamant, I won't even take them as a client. They really do need. Here's the deal. So to your point, one last thing here: when let's say you work on repairing your credit on your own, every time you ask the bureaus or you ask a creditor or a collection company a question, by law they've got 30 days to get back to you. And if they don't answer you right the first time and you got to ask questions again, they have another 30 days. And if you ask it again, every time they have this statute of limitation to do their research. So you're betting that all those pegs are going to fit in the right square and round holes, when in this world, it just doesn't. So that's another reason why you're wanting to give yourself that window.
That's awesome. Well, thank you so much. I'm Tyler Ross, Ross Real Estate in Warrenton. RossVA.com is how you can find me.
Dave Couk, Integrity Home Mortgage, and Chad Kusner, Credit Repair Resources. Really appreciate your time today, Chad. Very insightful. Obviously, there's so much going on the credit side. I get the feeling Chad could talk about this all day long and not run out of stuff.
Oh, yeah. So how do
Interestingly enough, I do. Just to different people.
Yeah.
Well, how do people find you, Chad?
So you can check us out online at CRR760.com. That's Charlie Romeo 760.com. You can call me at my desk. I'm literally here till 7 almost every day at 216.
Or you can call me and I can hook you up with Chad.
Or call Dave and he can hook you up with us. But I'm also at 216-245-1115. And listen, like I said, I don't care what the question is. If it's not even repair related, call us. We'll do what we can to help you.
Awesome.
Awesome. Chad, thank you very much.
It's my pleasure. Thanks for having me, gentlemen.
Soon, buddy.
Have a great day.
Hey, we're done recording.
Bye-bye now.
So thank you, Chad. Appreciate it, man. That was great.
No worries. Thank you. And then let me know where you guys post that up.